Everything that works on a cycle is predictable, including financial markets. We know down to the minute when the sun will rise and when the sun will set every single day of the year, and we're never wrong. The diurnal cycle of day and night is predictable to us because we know how it works. We understand the basic laws of physics that control the rotation of the Earth and its revolution around the sun. And yet, whenever we talk about money or investments, we are asked to believe that the market cycle is largely random and unpredictable. You never know what the market might do. Even the top central bankers at the Fed, such as Ben Bernanke and Janet Yellen, have an abysmal record of predicting recessions. And some of the top voices in global banking, such as Jamie Dimon from JP Morgan Chase, never get tired of making bad predictions in the press about when the next recession is going to come. Maybe he's going to be right this time, even though he's been wrong the past 5 years and nobody has seemed to notice. How can it possibly be that our knowledge of science is so advanced that we know the half-life of various isotopes of hydrogen with exacting precision, and yet we don't even know how market cycles work in the economy? And yet, when you actually look at long-term real estate market data, there's an obvious pattern. From the cyclical peak in the real estate market in Q3 of 1973 to the peak in Q4 of 89 was 16 years and 3 months. From the peak in 89 to the next peak in Q1 of 2006 was also 16 years and 3 months. And then from 06 to the current peak of Q4 in 2024 has been 18 years and 9 months so far. So there's a clear tendency for the real estate market to peak in intervals of between 16 and 20 years. And it's way too much to be random. If it was really random, it would never be that predictable. And you would not have a frequency in the data that was that clear. But you do. But let's look more closely, because when you look at this chart and you look for the deepest and most severe recessions on record, which are referred to as the thicker gray bars on this chart, all of those really bad recessions took place in market cycles where housing prices were falling. You saw it in 74 to 75, 81 and 82, and then of course from 2007 to 2009. And when you look at all the other recessions, the ones that were much more mild and short-lasting recessions, including the dot-com bubble of 2001 and the pandemic recession in 2020, they all took place in markets where housing prices were rising. Something's going on. There's an obvious pattern here, right? Like, it's too much to be a coincidence. And wherever there is a pattern like this, there are rules that are driving the pattern. Whenever the pattern has a rhythm to it, it means that someone or something is keeping time. Believe it or not, there's a group of economists and market analysts that believes that they've found the clock that controls the market cycles and predicts recessions, and they've been keeping time for a number of years now.
The current cycle started around 2011, 2012, and we are approaching the end of the first half of the cycle and should be expecting or experiencing, indeed in some parts of the world, a mid-cycle slowdown. They're typically not very long, and central banks reverse interest rate policies, governments act to stimulate the economy, and we typically get out of those recessions relatively quickly, and that stimulus sets up the second half of the cycle.
We talk about asset markets, but let's talk firstly about the real estate sector. 14 years up, 4 down. It's as simple as that. I've traced that history back right to 1800 in the United States.
Phil Anderson and Akil Patel got on my radar when I listened to some of the interviews they gave in 2019 and 2020, when they matter-of-factly predicted that the pandemic recession would be short-lived and transient, which was very far from being obvious to me and a lot of other people at that time. The reason that their outlook proved to be accurate, and the reason that they were so calm and collected when everybody else was panicked, was because they subscribed to a relatively unknown concept in market forecasting called the 18.6-year real estate cycle. The idea is that the real estate market tends to follow a pattern of 14 years up and 4 years down. That the 14-year expansion in the market is typically split into 2 7-year increments by a mid-cycle slowdown like 2001 and 2020, where there's a period of disruption and then the market continues to rise shortly thereafter. Apparently, when you actually look back in the data, this pattern of the real estate cycle that they're talking about goes back very far in the data, even back into the 1800s, where data is available. The 18.6-year real estate cycle gets its name not because every single cycle is 18.6 years exactly, but because when you actually look throughout history, that is the average duration of the cycle overall. There's a lot of interesting stuff to learn about the 18.6-year real estate cycle, but in this video, I'm just going to highlight a few of the most important concepts that really matter most to a general audience. Number one is why real estate prices drive the market cycle, not stocks. Number two is why the long-term trends in real estate prices are so predictable. And then number three is how real estate prices can be used to predict changes in the economy overall. There's a couple reasons why the real estate cycle drives market cycles way more than the stock market. And a lot of it has to do with the fact that real estate is way more fundamental to banking and credit cycles. And it's really credit cycles that drive market expansions and contractions. When credit is available, banks are lending and money goes into the system, the economy expands. But when credit dries up, the banks are struggling and the market conditions contract, unemployment rises, and the economy worsens. So in this framework, it's very important that real estate is really the primary driver of bank lending in the economy. And bank lending that goes to real estate mortgages actually expands the supply of money in the economy, which creates liquidity and it creates appreciating asset markets and the rising values in housing markets, as well as other financial assets such as stocks. For example, when you actually look at the last 10 years of the M2 money supply chart, what you see is that when you go from the M2 chart to the chart that shows inflation-adjusted residential real estate prices, it's the same chart. So you really see this very clear correlation between bank lending and real estate values. And it's not a coincidence. It's very much for a reason. And as the bank lending goes into real estate prices rise, which means that real estate is more lendable because the people that own property have more equity in their homes. So they can get loans against the appreciated equity in their homes, which further drives liquidity into the market and further drives gains in financial assets. Even though the real estate market and the stock market are similar size markets in the US, ownership of stocks is much more concentrated in the top 10% of American household wealth. And yet for the typical household, real estate is about 2/3 of household net worth. And so for the average person living in America, the value of their home is the main driver of their wealth. For that reason, the real estate cycle has a more broad-based effect in terms of American consumer sentiment, consumer spending power, and consumer net worth. And so for that reason, changes to the real estate market have a more immediate effect to the majority of Americans that own property, but might not own as much in terms of stocks. It is real estate that is the leading indicator of stocks. It's not the other way around. And the historical data is very clear on this. Because when inflation-adjusted real estate values bottomed and started appreciating again in 1996, that is really when the S&P 500 took off. And that's when the most significant gains in the stock market took place prior to the dot-com bubble in 2001. But when that dot-com bubble burst in the stock market, it was the rising real estate prices that came in the years to follow that pulled us very quickly out of that recession. But it was in 2006, in the peak in real estate, when the real estate market started to decline, that made the stock market collapse in Q4 2007 inevitable. The writing was on the wall because the stock market was never going to sustain the valuation that it had in the context of a falling real estate market and the systemic banking crisis that is going to create. A rising tide lifts all boats, and the rising tide is the market, but the unseen gravity that pulls the market is housing. This is the key. When you're looking at the stock market as a leading indicator of where the economy is headed, you're looking at the wrong thing. The secret clock that controls markets and predicts recessions is the housing market. And the housing market moves slowly with great momentum. And because housing prices have such momentum, as long as housing prices are rising, no recession is likely to last. Because housing prices going up holds the roof up over the banking system, which greases the wheels of the entire economy. In this way, the real estate cycle is predictable because it swings on momentum, just like a clock. When housing prices start to swing higher, they pull more credit into the system. And this liquidity from bank lending is going to push house prices higher and higher and higher based on that momentum and the feedback loop it creates, up until a point where the underlying rental income from real estate is not enough to service the existing debt load and the monthly payments on these mortgages. And it's at that point where owners become motivated sellers and motivated buyers disappear and they stay on the sidelines. And that is when real estate prices fall, which further contracts the credit conditions in the market. Bank lending dries up. Bank failures start to show up in the data and in the news cycle. And that's where the whole economy starts to unravel. 14 years up, 4 years down. When you understand the importance and the simplicity of the real estate cycle, you have something like a secret clock. It's a clock that doesn't give you the exact timing, because no clock is perfect. But what it does give you is the sequencing. It shows you the order of events as they unfold. And based on where the housing market is at any given time, it's going to give you a really good ability to predict where we are in the cycle, what's likely to happen next, and why. If you like this video, I want to leave a link to the next video on our channel that's going to talk about America's real trade war. No, not the one you're hearing about in the news, not with the tariffs, not with China or any of the trade relationships. I'm talking about the real trade war. The real trade war that no one's talking about that's happening inside America right now if you know where to look. So watch this video. I think you're really going to enjoy it.